Hi, this is Erin Parks with Parks Ag Solutions, and this is what I call our marketing assistance program, where we do a little bit of a deeper dive into an agricultural topic. So, this month of June, this is going out at the end of June. We're going into the comparison with the markets between 2014 and 2024, which is what we're in right now. The information came up from some of my own personal experience, but also University of Illinois' website and a couple of news articles. So pretty much, let's start marketing like it's 2014, or maybe the question becomes, are you going to market like it's 2014? So actually these comparisons of 2024 and 2009 or 2014 actually all came together honestly pretty early in the year. Probably back in February was probably the first correlation that I had heard of, and especially with technical traders. So those that really got into the charts and those traders that really studied that. So just for an example of kind of what I'm talking about. So on June 26th of this year of 24, December corn was trading at 443 and a quarter, while June 26th of 2014, it was trading at 443 and a quarter. So very close and a lot of correlation. So let's look at a couple of charts here. And what we're going to look at is 2014 is kind of what we're going to start at. This particular chart, I couldn't go back further and get it as a snapshot. I couldn't go back between after, before there, the middle of June, but you can see how we started there the middle of June and pretty much then just worked our way lower through the growing season and the growing months, and we bottomed then in October and rallied after that. So that is 2014. Let me pull up 2024, which is where we're at right now. And you can see this goes back before the middle of June. But let's say we go back to the middle of June, just like that other chart, you can see why the comparison has been going on. And while these technical traders have been talking about, because look, the graph is almost exactly the same. We saw that lower downward trend in 2014, and we see that lower trending line in 2024 as well. So that's some of the comparisons. So let's talk about some of the differences. I would say first off is going to be corn yield. Corn yield in 2014 was at 171. 2024 is a question mark, but it sounds like we're going to be anywhere from that 181 to 183. Another difference is what ending stocks are coming in to the current year. So the ending stocks in 2013, so old crop that went into new crop, was 1.2 billion bushels. In 23, coming into the 24 crop of what we're bringing in is 1.8 billion bushels. And so what that does is that increases ending stocks. And a lot of times what people like to talk about is the stocks to use ratio. So in 2013, going into 2014, the stocks to use ratio was 7.4. So stocks, and then that percentage of usage. In 2023, the stocks to use ratio was a 12.6. So we are seeing some differences just of the amounts that of crop we're going to grow in 12 and what was grown in 14 and what was grown in 24. And then what old crop is being brought in to new crop from 2013 and 2023. So what this does, that reduces volatility. So as you increase that stocks to use ratio, we see the market movement get smaller because the market isn't concerned. With stocks to use ratio below 10%, the market's not concerned about coming up with any extra bushels because they know they're out there somewhere. Then we talk about demand. We usually say low prices fix low prices. So hopefully if this downward trend continues into the 24, and we saw in 14 at bottom in October, if that happens here in 24, hopefully then what we see is an increase in buying from the export market usage. Maybe people switch up their rations of what they're using on the corn. So marketing, what do we do? What worked really best in 2014 was avoiding fall delivery, because if you saw, we bottomed there in October. And also during that time, we really fought some low basis levels as well. So the markets were moving lower, the basis was getting wider, making the cash price even smaller. So what did work best was avoiding fall delivery as much as we could, and then forward selling for December, forward selling for January, forward selling for February delivery, because usually those years of big crops, which is what we're expecting here in 24, you usually see the further out months have better prices. Where people got stuck in 24, and I'll be honest, is they were like, I'm going to put it in the bin and then I'll sell it in January when it was higher. And when it got to January, it wasn't higher. Or like, I'm going to put it in the bin and then I'm going to sell it when the market rallies in February, March, because that's usually what happened. And that didn't happen. So unfortunately, there was some times in 2014 where people held grain and they actually ended up with the same price, if not lower than what they could have got, say, right after fall delivery. So keep that in mind. Another kind of play that worked out good marketing wise was selling the crop fairly early. And then buying a call. So those that decided to move their grain by the end of the year, or say by the end of January, and then they just bought a call to cover that. I'll be honest, I can't say the calls always made money, but it gave them that protection if the market did go up. So marketing like it's 2014, avoid fall delivery, forward sell, or do some selling and buy some calls to cover that if the market would rally. So, hey, thanks for watching this marketing video for June. We'll come up with another one for July. If you have any questions about this or anything else that pops up, I'd be happy to have a conversation with you. Thanks. End.